Here are a few jargons that we will look into. Strike price. Underlying price. Exercising of an option contract. Option expiry. Option premium. Option settlement. Since we have only looked at the basic structure of a call option, I would encourage you to understand these jargons only with respect to the call option. Strike price. Consider the strike price as the anchor price at which the two parties, buyer and seller, agree to enter into an options agreement. For instance, in the previous video's Anand Balu example, the anchor price was 5 lakh rupees, which is also the strike price for their deal. We also looked into a stock example where the anchor price was 75 rupees, which is also the strike price. For all call options, the strike price represents the price at which the stock can be bought on the expiry day. For example, if the buyer is willing to buy ITC Limited's call option of 195 rupees, 195 being the strike price, then it indicates that the buyer is willing to pay a premium today to buy the rights of buying ITC at 195 rupees on expiry. Needless to say, he will buy ITC at 195 rupees, only if ITC is trading above 195 rupees. In fact, here is a snapshot from NSE's website where I have captured different strike prices of ITC and the associated premium. The table that you see above is called an option chain, which basically lists all the different strike prices available for a contract along with the premium for the same. Besides this information, the option chain has a lot more trading information such as open interest, volume, bid-ask quantity, etc. I would suggest you ignore all of it for now and concentrate only on the highlighted information. The highlight in maroon shows the price of the underlying in the spot. As we can see, at the time of this snapshot, ITC was trading at 194 rupees and 55 paise per share. The highlight in blue shows all the different strike prices that are available. As we can see, starting from 180 rupees we have strike prices all the way up to 210 rupees. Do remember, each strike price is independent of the other. One can enter into an options agreement at a specific strike price by paying the required premium. For example, one can enter into a 194.85 call option by paying a premium of 6 rupees and 85 paise, highlighted in red. Underlying price. As we know, a derivative contract derives its value from an underlying asset. The underlying price is the price at which the underlying asset trades in the spot market. For example, in the ITC example that we just discussed, ITC was trading at 194 rupees and 55 paise in the spot market. This is the underlying price. For a call option, the underlying price has to increase for the buyer of the call option to benefit. Exercising of an option contract is the act of claiming your right to buy the options contract at the end of the expiry. If you ever hear the line, "exercise the option contract," in the context of a call option, it simply means that one is claiming the right to buy the stock at the agreed strike price. Clearly, he or she would do it only if the stock is trading above the strike. Here is an important point to note: you can exercise the option only on the day of the expiry and not anytime before the expiry. Hence, assume with 15 days to expiry, one buys ITC 194.85 call option when ITC is trading at 192.50 in the spot market. Further assume, after he buys the 194.85 call option, the stock price increases to 195 the very next day. Under such a scenario, the option buyer cannot ask for a settlement he cannot exercise against the call option he holds. Settlement will happen only on the day of the expiry, based on the price the asset is trading in the spot market on the expiry day. Similar to a futures contract, options contract also has expiry. In fact, both equity futures and option contracts expire on the last Thursday of every month. Just like futures contracts, option contracts also have the concept of current month, mid-month, and far month. Have a look at the snapshot below. This is the snapshot of the call option to buy Ashok Leyland Limited at the strike price of 68 rupees at 3 rupees and 95 paise. As you can see, there are 3 expiry options: the 24th of September 2020 current month, the 29th of October 2020 mid-month, and the 26th of November 2020 far month. Of course, the premium of the options changes as and when the expiry changes. Premium is the money required to be paid by the option buyer to the option seller or writer. Against the payment of premium, the option buyer buys the right to exercise his desire to buy, or sell in case of put options, the asset at the strike price upon expiry. It is important to understand that the whole of option theory hinges upon option premium. Option premiums play an extremely crucial role when it comes to trading options. Let us revisit the Anand Balu example that we took up in the previous chapter. Consider the circumstances under which Balu accepted the premium of 1 lakh rupees from Anand. News flow: the news on the industrial project was only speculative and no one knew for sure if the project would indeed come up. Time: there was 6 months' time to get clarity on whether the project would fructify or not. Now let us consider both these points in isolation and figure out the impact it would have on the option premium. News: when the deal was done between Anand and Balu, the news was purely speculative, hence Balu was happy to accept 1 lakh rupees as premium. However, for a minute assume the news was not speculative and there was some sort of bias. Maybe there was a local politician who hinted in the recent press conference that they may consider a industry in that area. With this information, the news is no longer a rumor. Suddenly there is a possibility that the industry may indeed come up, albeit there is still an element of speculation. With this in perspective, think about this: do you think Balu will accept 1 lakh rupees as premium? Maybe not. He knows there is a good chance for the industry to come up and therefore the land prices would increase. However, because there is still an element of chance, he may be willing to take the risk, provided the premium will be more attractive. Maybe he would consider the agreement attractive if the premium was 1,75,000 rupees instead of 1 lakh rupees. Now let us put this in stock market perspective. Assume Infosys is trading at 2,200 rupees today. The 2,300 call option with a 1-month expiry is at 20 rupees. Put yourself in Balu's shoes, option writer. Would you enter into an agreement by accepting 20 rupees per share as premium? If you enter into this options agreement as a writer seller, then you are giving the right to the buyer of buying Infosys option at 2,300 rupees 1 month down the lane from now. Assume for the next 1 month there is no foreseeable corporate action which will trigger the share price of Infosys to go higher. Considering this, maybe you may accept the premium of 20 rupees. However, what if there is a corporate event, like quarterly results, that tends to increase the stock price? Will the option seller still go ahead and accept 20 rupees as the premium for the agreement? Clearly, it may not be worth to take the risk at 20 rupees. Having said this, what if despite the scheduled corporate event, someone is willing to offer 75 rupees as premium instead of 20 rupees? I suppose at 75 rupees, it may be worth taking the risk. Let us keep this discussion at the back of our mind. We will now take up the second point as time. When there was 6 months' time, clearly Anand knew that there was ample time for the dust to settle and the truth to emerge with respect to the industrial project. However, instead of 6 months, what if there was only 10 days' time? Since the time has shrunk, there is simply not enough time for the event to unfold. Under such a circumstance, with time not being on Anand's side, do you think Anand will be happy to pay 1 lakh rupees premium to Balu? I don't think so, as there is no incentive for Anand to pay that kind of premium to Balu. Maybe he would offer a lesser premium, say 20,000 rupees instead. Anyway, the point that I want to make here, keeping both news and time in perspective, is this: premium is never a fixed rate. It is sensitive to several factors. Some factors tend to increase the premium and some tend to decrease it, and in real markets, all these factors act simultaneously affecting the premium. To be precise, there are 5 factors similar to news and time that tends to affect the premium. These are called the option Greeks. In real markets, premiums vary almost on a minute-by-minute basis. Consider this call option agreement. As highlighted in green, this is a call option to buy GMR Infrastructure Limited at 23 rupees. The expiry is the 24th of September 2020. The premium is 2 rupees and 10 paise, highlighted in red, and the market lot is 45,000 shares. Assume there are 2 traders, Trader A and Trader B. Trader A wants to buy this agreement, option buyer, and Trader B wants to sell, write, this agreement. Considering the contract is for 45,000 shares, here is how the cash flow would look like. Since the premium is 2 rupees and 10 paise per share, Trader A is required to pay the total of equals 45,000 multiplied by 2.10 equals 94,500 rupees as premium amount to Trader B. Now, because Trader B has received this premium from Trader A, he is obligated to sell Trader A 45,000 shares of GMR Infrastructure Limited on the 24th of September 2020, if Trader A decides to exercise his agreement. However, this does not mean that Trader B should have 45,000 shares with him on the 24th of September. Options are cash settled in India. This means on the 24th of September, in the event Trader A decides to exercise his right, Trader B is obligated to pay just the cash differential to Trader A. To help you understand this better, consider on the 24th of September GMR Infrastructure Limited is trading at 30 rupees. This means the option buyer, Trader A, will exercise his right to buy 45,000 shares of GMR Infrastructure Limited at 23. In other words, he is getting to buy GMR Infrastructure Limited at 23 when the same is trading at 30 rupees in the open market. Normally, this is how the cash flow should look like. On 24th, Trader A exercises his right to buy 45,000 shares from Trader B. The price at which the transaction will take place is pre-decided at 23 rupees strike price. Trader A pays 10 lakhs 35,000 rupees, that is 45,000 multiplied by 23 to Trader B. Against this payment, Trader B releases 45,000 shares at 23 rupees to Trader A. Trader A almost immediately sells these shares in the open market at 30 rupees per share and receives 13 lakhs 50,000 rupees. Trader A makes a profit of 3 lakhs 15,000 rupees, that is 13 lakhs 50,000 minus 10 lakhs 35,000 on this transaction. Another way to look at it is that the option buyer is making a profit of 7 rupees per share, that is 30 to 23 per share. Because the option is cash settled, instead of giving the option buyer 45,000 shares, the option seller directly gives him the cash equivalent of the profit he would make. Which means Trader A would receive equals 7 multiplied by 45,000 equals 3 lakhs 15,000 rupees from Trader B. Of course, the option buyer had initially spent 94,500 rupees per towards purchasing this right, hence his real profits would be equals 3 lakhs 15,000 minus 94,500 equals 2 lakhs 20,500 rupees. In fact, if you look at in a percentage return terms, this turns out to be a whopping return of 233% without annualizing. The fact that one can make such large asymmetric return is what makes options an attractive instrument to trade. This is one of the reasons why options are massively popular with traders.